Bitcoin just hit $63,000, down nearly 50% from the peak. 2.5 billion in liquidations last week. The fear and greed index hit 12. Extreme fear. CNBC rolled out every crypto skeptic from the last decade. Bloomberg published 3 obituaries. Reddit threads are filling with "I told you so" posts. Twitter's having a collective panic attack. And my inbox is flooded with one question: is Bitcoin dead? Here's what nobody's telling you. This is the 462nd time Bitcoin has been declared dead. I'm serious. There's literally a website that tracks this. 461 documented obituaries since 2010. Paul Krugman wrote one in 2011 when Bitcoin was at $2.33. The New York Times wrote one in 2013 at $1,000. Bloomberg wrote 3 in 2018 when it crashed to 3,200. And now, here we are again, watching the same script play out for the 462nd time. So I'm going to explain exactly what's happening right now, why this crash follows a pattern you can literally set your watch to, and what the smart money is doing while everyone else is panic selling. Because here's the thing, the obituaries always come at the bottom. Always. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Look, think of Bitcoin like a patient in a hospital. Every few years, a doctor walks in, checks the vitals, sees the heart rate monitor doing something weird, and confidently pronounces the patient dead. They write up the death certificate, they call the family, they start making funeral arrangements, then the patient sits up in bed, asks what's for lunch, and walks out of the hospital completely fine. The doctor looks like an idiot, the family's confused, and the funeral home is stuck with a bunch of flowers nobody needs. This has happened 461 times. Same hospital, same patient, different doctors. But here's where it gets interesting. Every single time a doctor wrote that death certificate, if you had bought the patient's estate thinking you were getting a deal on a corpse, you would have made a fortune. Because the patient never actually died. The doctors just kept misreading the vitals. Let me show you the numbers. November 15th, 2011, Wired magazine publishes an article titled "The Rise and Fall of Bitcoin." They quote Paul Krugman, Nobel Prize winner in economics, who says Bitcoin is fundamentally structured like a pyramid scheme. Death certificate number 37. Bitcoin's price at the time? $2.33. Today's price? $63,487. That's a 27,250 times return. If you invested $1,000 when Krugman declared it dead, you'd have $27 million today. But I'm sure the Nobel Prize winner knew what he was talking about. December 2013. Bitcoin crashes from $1,000 to $200. Krugman writes another obituary. This time he's certain. The bubble has popped. The technology has failed. It's over. Except Bitcoin went from $200 to $69,000 by November 2021. That's a 345 times return from the point where the expert declared it worthless. January 2018. Bitcoin crashes from $20,000 to $3,200, an 84% collapse. The New York Times, Bloomberg, Wall Street Journal, they all write obituaries. The consensus is unanimous. This time, it's really dead. The bubble finally popped. Then Bitcoin went from 3,200 to 69,000 by November 2021. That's a 2,156% gain from extreme fear. Now you're asking yourself, why does this keep happening? Why do the experts always get it exactly wrong? Here's what I learned running my own business for 20 plus years, surrounded by people who actually move money instead of just talking about it. The experts aren't looking at the right data. They're looking at price. Price is just collective opinion. It's what the market thinks something is worth right now, today, this minute, based on fear and greed and momentum and narrative. But price isn't value. Value is what something actually does. The network, the technology, the adoption rate, the infrastructure being built. And every single time Bitcoin's price crashed, those fundamentals kept improving. The network kept processing transactions. Miners kept mining blocks. Developers kept shipping code. Adoption kept growing. The doctors keep pronouncing the patient dead because they're checking the wrong vital signs. They're looking at the price chart like it's a heart rate monitor. But a price chart isn't measuring health. It's measuring sentiment. And sentiment swings wildly. One day everyone's euphoric, the next day everyone's suicidal. But the actual patient, the Bitcoin network, has produced a block approximately every 10 minutes for over 15 years without a single hour of downtime. That's better uptime than most banks. Here's the first thing nobody tells you about these crashes. They serve a very specific purpose. They transfer Bitcoin from weak hands to strong hands. From people who bought because their cousin told them to people who understand the technology. From retail panic sellers to institutional patient buyers. From sardines to whales. This isn't a bug. This is the feature. Every cycle, the same transfer mechanism plays out. Price goes up, retail piles in at the top. Price crashes, retail panic sells at the bottom. Institutions quietly accumulate. Price recovers, new all-time high. Repeat. And right now, we're in the transfer phase. I can prove it. Let's talk about MicroStrategy. As of February 2nd, 2026, they hold 528,520 Bitcoin. That's $54.26 billion invested at an average price of $76.52 per coin. Bitcoin's at 63,500 right now. That means MicroStrategy is sitting on a paper loss of about 16.5%. Their average buy price is higher than the current market price. They're underwater. And what did Michael Saylor do last week when the Fear and Greed Index hit 12, when CNBC was writing obituaries, when retail was panic selling? He bought more. 855 Bitcoin for $75 million. Let that sink in. The largest corporate holder of Bitcoin in the world, sitting on a paper loss, doubled down during the crash. Does that sound like a man betting on a dying asset? Or does that sound like a man with unshakable conviction who understands that price and value are two different things? Now, you might be thinking, okay, fine, but MicroStrategy is run by a Bitcoin zealot. What about the boring institutional money? The pension funds, the asset managers, the guys in suits who move trillions? Let me tell you about BlackRock. BlackRock manages $12.5 trillion. That's trillion with a T. They're the largest asset manager on planet Earth. They launched their Bitcoin ETF, ticker symbol IBIT, in January 2024. In just 2 years, it became the largest Bitcoin ETF in existence. How much Bitcoin does BlackRock's IBIT hold? 784,000 Bitcoin, around $70 billion in assets under management. And 3 weeks ago, in late January 2026, while Bitcoin was crashing from 126,000 to 63,500, what did BlackRock do? They filed to launch a second Bitcoin product, the iShares Bitcoin Premium Income ETF. Let me walk you through the logic here. Bitcoin drops 49.6%. Retail is capitulating. Media's writing obituaries. The Fear and Greed Index is at 12. And BlackRock's response is to double down and launch another Bitcoin product. Does that make sense if Bitcoin is dead? Would the world's largest asset manager, with fiduciary responsibility to pension funds and endowments and retirement accounts, invest millions in legal compliance, custody infrastructure, marketing, and distribution, all for an asset they think has no future? No, they wouldn't. Because here's what people don't understand about institutions. They don't make emotional decisions. They have teams of analysts, quantitative researchers, risk managers, legal experts. They run Monte Carlo simulations. They model long-term adoption curves. They analyze network effects and supply dynamics. And every major institution that has studied Bitcoin deeply, including BlackRock, has come to the same conclusion. Long-term structural value. Now here's where it gets really interesting. US Bitcoin ETFs collectively hold 1.3 million Bitcoin. That's about 6% of the total supply that will ever exist. Think about that. Institutional products launched just 2 years ago now control 6% of Bitcoin's entire supply. And the amount isn't shrinking, it's growing. Bank of America, with $3.5 trillion in assets under management, now recommends Bitcoin ETFs to clients. Vanguard, which famously refused to offer Bitcoin products for years, reversed course in 2025. They now offer Bitcoin exposure to 8 million clients. Wells Fargo opened Bitcoin ETF distribution. Morgan Stanley filed registration to launch their own spot Bitcoin ETF. You're telling me Bitcoin is dead while every major financial institution in America is building infrastructure to offer it to their clients? The math doesn't math. But now you might be thinking, Okay, but what about those outflows? The ETFs had 1.6 billion in outflows last week. That's bearish, right? Is it? ETF flows are noisy. They fluctuate daily based on short-term sentiment. But since launch, Bitcoin ETFs have attracted $56 billion in cumulative net inflows. 56 billion. Yes, there are outflows during fear. That's what fear looks like. But zoom out. The long-term trajectory is capital flowing into Bitcoin through institutional channels, not out. And here's the logic that should be painfully obvious. BlackRock doesn't create ETFs for assets they think will go to zero. MicroStrategy doesn't accumulate 528,000 Bitcoin if they think it's worthless. Banks don't recommend allocation to dying assets. These are sophisticated, risk-averse institutions with legal obligations. If Bitcoin was truly dead, they'd be winding down exposure and cutting losses. But they're doing the opposite. They're expanding product lines and building infrastructure. Let's talk about fear and greed, because this is the second thing nobody tells you. The Crypto Fear and Greed Index measures market sentiment on a scale from 0 to 100. 0 is extreme fear, 100 is extreme greed. Right now, we're at 12, extreme fear. What does that actually mean? It means retail is in full panic mode. Emotions are driving decisions. Logic has left the building. But here's the fascinating part. Extreme fear is historically a buy signal, not a sell signal. November 2022, Fear and Greed Index hit 10. Bitcoin was at 15,500. Everyone was convinced it was going to zero. FTX had just collapsed. Three Arrows Capital went bankrupt. Celsius froze withdrawals. The entire industry looked like a house of cards. Then what happened? Bitcoin rallied to 126,000 over the next 34 months. That's an 813% gain from extreme fear. March 2020. Fear and Greed Index hit 8. Bitcoin was at 3,800. The world was shutting down for COVID. Panic was everywhere. Then Bitcoin went to 69,000 in 21 months. 1,816% gain from extreme fear. December 2018. Fear and Greed Index hit 10. Bitcoin was at 3,200. The bear market had lasted 12 months. Everyone gave up. Then Bitcoin went to 69,000 in 35 months. 2,156% gain. See the pattern? Extreme fear marks bottoms. Not always immediately, not always perfectly, but historically when the index hits extreme fear, you're much closer to a bottom than a top. And right now we're at 12. Now, does that mean Bitcoin can't go lower? Absolutely not. We could test 60,000, maybe 55,000. Markets overshoot. Emotions drive prices beyond rational levels. But based on historical data, we're probably in the late stages of capitulation, not the early stages. Now, let me tell you about leverage, because this is the third thing nobody mentions. Last week, $2.5 billion in leveraged crypto positions got liquidated. $2.5 billion. In a few days. These weren't sophisticated investors. These weren't patient long-term holders. These were gamblers using borrowed money, betting Bitcoin would only go up, and they got completely destroyed when it went down. When Bitcoin falls fast, exchanges automatically close leverage positions to prevent further losses. This creates a cascade. Forced selling pushes prices lower. Lower prices trigger more liquidations. More liquidations create more selling. It's a death spiral. But here's the key insight. Every Bitcoin that gets liquidated gets bought by someone. And that someone is usually someone with cash, someone without leverage, someone patient. This is how Bitcoin moves from weak hands to strong hands. From people gambling with borrowed money to people investing with actual capital. And right now, we just witnessed one of the largest liquidation events of the entire cycle. 2.5 billion in leverage, gone, cleared from the system. What does that mean? The market is cleaner now. Less leverage, less speculation, less gambling. More real holders with conviction. Markets with less leverage are healthier. They're more stable. They're less prone to cascading crashes. They're ready to build a foundation for the next leg up. But here's my message. Do not be part of the next liquidation event. Do not use leverage. Do not borrow money to buy Bitcoin. If you can't sleep at night because you're worried about Bitcoin's price, you're overexposed, period. Reduce your position to a level where a 50% drop wouldn't destroy your life. Because Bitcoin will drop 50%, maybe multiple times. That's the nature of the asset. That's the price you pay for asymmetric upside. If you can't handle that volatility, you're not investing. You're gambling. Imagine you're a mortgage broker in late 2007. You've watched housing prices climb for years. Everyone around you is levered to the eyeballs, flipping properties with nothing down, making fortunes on paper. You're feeling pressure. Your neighbor just bought his third rental property with a subprime loan. Your brother-in-law quit his job to flip houses full-time. You start thinking maybe you should get in. Maybe you should take out a home equity line of credit and buy a few investment properties. Everyone's doing it. Everyone's making money. Then 2008 happens. Prices collapse. Your neighbor loses all 3 properties to foreclosure. Your brother-in-law is bankrupt. Everyone who used leverage got wiped out. Meanwhile, the guy who saved cash and waited bought properties at 30 cents on the dollar during the panic. Same asset, different outcomes. The difference was leverage and patience. Bitcoin works the same way. Right now feels like late 2007. Prices are down, fear is high, leverage is getting flushed, the panic sellers are capitulating, and the patient accumulators with actual capital are quietly buying. The question is, which side are you on? Here's the 4th thing nobody tells you. Bitcoin has a strange, almost mechanical pattern. Every 4 years, we see a major peak, followed by a deep correction, followed by recovery to new all-time highs. 2013, peak at $1,150, crashed 84% to $177, recovered to new highs by 2017. 2017, peak at 19,800, crashed 84% to 3,200, recovered to new highs by 2021. 2021, peak at 69,000, crashed 77% to 15,500, recovered to new highs by 2025. 2025, peak at 126,000, currently down 46.5% to 63,500. Notice something? The peaks keep getting higher, but the crashes are getting less severe. 2013, 84% crash. 2017, 84% crash. 2021, 77% crash. This cycle, we're at 46.5% so far. Bitcoin is maturing, the volatility is decreasing. The market structure is changing. Why? Because institutional capital is entering. In 2013, it was 99% retail speculation. In 2021, maybe 70% retail. Now it's probably 50-50, maybe even 40-60 institutions if you count all the ETF capital. As institutional capital increases, volatility decreases. Not eliminated, but moderated. Could the 4-year cycle break? Could Bitcoin not recover this time? Yes, it's possible. History doesn't guarantee the future. But for the cycle to break, the fundamentals would need to break. The network would need to fail. The technology would need to be superseded. Adoption would need to reverse. Has any of that happened? Network hash rate at all-time highs, transaction volume steady, minor capitulation not happening, adoption reversing, nope. BlackRock expanding Bitcoin products, MicroStrategy still accumulating, nation-states building strategic reserves. Technology failure? The blockchain has produced a block every 10 minutes for 15 years without interruption. So if none of the fundamentals have deteriorated, why would the cycle break? Price is perception. Price is the market's temporary opinion about future value, and opinions change fast. Everything that made Bitcoin valuable at 126,000 still exists at 63,500. Only the perception has changed. And perception always corrects eventually. Let me give you a concrete scenario. You're 42 years old. You've been dollar cost averaging into Bitcoin for 3 years. You've put in $20,000 total buying $500 a month. Your average cost basis is around $78,000 per Bitcoin. You own about 0.25 Bitcoin. At the peak in October 2025, your position was worth $31,500. You were up $11,500. You felt smart. You told your wife maybe you'd pay off the car early. Then the crash happened. Today, your position is worth $15,875. You're down $4,125, 20% in the red. Your wife is asking questions. Your buddy at work who told you Bitcoin was a scam is giving you that look. You're thinking about selling. Here's what you need to understand. If you sell now, you lock in a 20% loss. That $4,125 is gone forever. You gave it to whoever bought your Bitcoin. But if you continue dollar cost averaging during this fear, you're buying Bitcoin at a 46% discount from the peak. Your next $500 purchase gets you 0.00787 Bitcoin instead of 0.00397 Bitcoin like it did at the peak. You're accumulating twice as much Bitcoin per dollar. In 2 years, when Bitcoin is back above 100,000, that decision to keep buying during fear will look genius. But only if you don't panic now. Here's a conversation I'm imagining between two investment committee members at a pension fund. Jim from Risk Management says we should cut our Bitcoin allocation. We're down 46%. The board is nervous. This looks bad in the quarterly report. Susan from Strategy says, Jim, our allocation is 2% of the portfolio. Our risk model accounted for 70% downside. We're within parameters, and our thesis was 5 to 10 year structural adoption. Nothing about the thesis has changed. If anything, the discount makes the risk reward more attractive now. Jim says, but the headlines, Susan. Susan says, Jim, we don't invest based on headlines. We invest based on data, and the data says accumulate during fear, not capitulate. 6 months later, Bitcoin is at 90,000. Jim feels stupid. Susan gets promoted. Don't be Jim. Remember that website I mentioned at the beginning, bitcoindeaths.com? It says if you invested $100 every time Bitcoin was declared dead, you'd have $66,332,000 today. 66 million. Not from genius timing, not from luck, just from buying when everyone else was panicking, from doing the opposite of the crowd, from understanding that declarations of death are buying opportunities. So here's my final question for you. Are you going to believe the 460-second obituary, or are you going to trust the 15-year track record? Here are 3 things to actually do right now. 1. Check your position size. If a 50% drop would materially affect your life, your rent, your bills, your sleep, you're overexposed. Cut it down to a level where you genuinely don't care if it goes to 0. Because if you can't handle the volatility, you'll sell at the worst possible time. 2, if you're going to stay in, set up automatic purchases during fear. Don't try to time the bottom, you'll fail. Nobody can call the exact bottom. But buying consistently while the fear and greed index is below 20 has historically worked. 3, turn off the price alerts. Seriously. Checking the price every hour is not investing. It's self-torture. Decide your conviction level, size your position accordingly, then ignore it for 6 months. Let the market do its thing. Near term, I have no idea where price goes. Bitcoin might hit 60,000, might hit 58,000, might consolidate for months. Nobody knows. Long term, the architecture is intact, the network is secure, adoption is growing, the fundamentals are solid. So I'm trusting the engineering, not the obituaries. The patient keeps getting pronounced dead, but the patient keeps walking out of the hospital. At some point, you stop trusting the doctors and start trusting the patient's vitals. Don't work for money. Own the companies that do. And in this case, own the network that's rebuilding the financial system, whether the doctors believe it or not. See you next time.